Welcome to the Opening Bell Report.
If you're joining us today, you're likely someone who doesn't just skim the financial headlines.
Right, you want to actually look under the hood.
Exactly. You want to understand the mechanics driving the market. And today, we have a setup that perfectly fits that description.
We really do.
We are digging into an incredibly contrarian analysis report focused on a company that, honestly, the broader market seems to have completely abandoned.
It's a fascinating case study in market psychology.
Yeah, the core theme of this research is provocative. It's focused entirely on the idea of price for bankruptcy, why Wall Street might be wrong about BYND. We are, of course, talking about Beyond Meat.
I mean, here is a company that was once the undisputed darling of the stock market.
Oh, absolutely.
Universally hailed as the poster child for the future of global food consumption. Yet, the grim reality presented in this analysis report is that the stock is currently trading at just 79 cents.
79 cents.
Yeah, that is a staggering plunge, down over 99% from its absolute peak.
Which is wild to think about.
And if you look at Wall Street's overwhelming consensus right now, the base case assumption is that Beyond Meat is on an unavoidable glide path straight into Chapter 11 bankruptcy.
Which makes you wonder if the pendulum of market sentiment has just swung way too far.
Exactly.
The core thesis of the analysis report we're unpacking today is rooted in this classic contrarian trading philosophy. Think about your own experience watching the markets. Usually when 100% of the institutional crowd is, crowded onto one side of the boat.
The most profitable trade is often on the exact opposite side.
Right. Located by quietly stepping over to the completely empty side.
And that's really the mission for today's deep dive. We're going to unpack the asymmetric, high upside opportunity that this report argues is camouflaged right behind Wall Street's extreme pessimism.
We need to explore why being priced for absolute disaster might ironically be the very mechanism that sets up a massive rebound.
So let's start with the first major concept from the research.
Yeah, what they define as the price to die fallacy.
Right. The analysis points out that Wall Street's quantitative models are currently pricing Beyond Meat as if a total collapse is a mathematical certainty.
Pushing it right against its absolute 52-week low.
Exactly. Sitting at 79 cents means the stock is pinned relentlessly.
But here's my question. When the market literally prices in the absolute worst-case scenario as an inevitability, what does it actually do to the trading mechanics of the stock?
Well, it completely warps the normal rules of how an asset reacts to incoming data.
How so?
When you enter this price-to-die territory, the expectations surrounding the company's future are effectively zero. Consequently, the massive trading algorithms, the institutional models, they're all calibrated for a total wipeout.
So they literally expect nothing but failure.
Exactly. And when everyone expects you to fail completely, any news that is simply less bad than total failure acts as a massive shock to the system. Algorithms are forced to drastically and immediately reprice the stock upward because their baseline assumptions were invalidated.
So the bar for success is literally buried underground. We aren't talking about Beyond Meat suddenly announcing some miraculous return to hypergrowth.
Not at all.
The analysis report lays out some incredibly mundane catalysts that could trigger this systemic repricing.
Like what?
Well, it could be a simple debt restructuring agreement that buys them another 12 months. It could be a successful phase of corporate cost cutting, or honestly, just a marginal stabilization in quarterly sales volume.
Precisely. None of those events suggest the company is thriving.
Right.
But they absolutely prove the company isn't going bankrupt tomorrow. And when you connect this to the broader concept of asymmetric risk and reward, the math becomes incredibly compelling.
Right, because the downside is strictly capped.
Exactly. The stock is at 79 cents. The absolute maximum you can lose is 79 cents a share.
But the upside?
The upside, if the company simply manages to survive the year, is exponentially higher because of how violently those models have to adjust.
I love how the analysis report frames this dynamic. They argue that at this current valuation, investors are no longer paying a premium for a hypergrowth food company. They're essentially buying pennies for a survival lottery ticket.
A survival lottery ticket. That's a great way to put it.
Yeah, if the company goes under, you rip up the ticket. But if they just manage to keep a pulse, the payout could be massive.
And a huge part of that potential payout comes from the next major factor the research dives into.
The sheer volume of bets placed against the company.
Yes, we have to talk about the short squeeze powder keg.
Oh man, the data here is truly astronomical.
It indicates a level of concentrated pessimism you rarely see in the public markets. According to the analysis report, 37.64% of the stock's float is currently sold short.
37%. Let's give that some context for everyone listening. Usually, if you see a stock with a short interest of 10%, that's considered fairly high.
Right, and a bit risky for short sellers.
Exactly. Approaching 40% is incredibly rare. That translates to over 147 million individual shares that have been borrowed and sold by traders, betting the price will hit zero.
But the report highlights another metric that I think is even more critical to understanding the danger here: the days to cover ratio,
which currently sits at 14.15 days. Break down what that specific metric implies for the people aggressively betting against this stock.
The days to cover ratio is a very revealing calculation. It takes the total number of shares that are currently sold short again, over 147 million, and divides it by the stock's average daily trading volume.
So a ratio of 14.15 means?
It means that if every single short seller suddenly realized they were wrong and needed to buy back their shares to close out their negative bets, it would take 2 full weeks of average trading volume for them to simply locate and buy back the shares they owe.
2 full weeks of nonstop buying just to break even. If you've ever watched a short squeeze happen in real time, you know exactly how violent the charts can get. Think about the float as the actual number of shares available to trade on the open market.
Right.
If you have all those short sellers rushing for the exit at the exact same time, it's like trying to shove an elephant through a revolving door. The liquidity just isn't there to absorb that kind of panic.
And that creates a vicious feedback loop. When short sellers panic, their only mechanism to escape is to buy the stock,
which drives the price up.
Exactly. Because the demand instantly overwhelms the available supply, that forced buying drives the share price up rapidly. This sudden price spike triggers margin calls for other short sellers,
forcing them to panic and buy,
which drives the price up even higher. It's a self-fulfilling prophecy of forced buying.
The analysis report describes the stock right now as a coiled spring. Wall Street's greed in trying to squeeze every last penny out of this decline has essentially built a trap.
A massive trap.
Any flicker of unexpected positive news could ignite that power keg. An unexpected distribution partnership, a buyout rumor hitting the news wires, or an earnings beat.
And according to the research, one of the most logical sparks for that ignition is the looming possibility of an acquisition.
The prime acquisition target theory is fascinating.
It really exposes a massive valuation disconnect between financial analysts and corporate strategists. The analysis report points out that Beyond Meat's current market cap is hovering around $358 million.
Which sounds like a fortune, but let's inject a little dry reality into that number. Wall Street is currently valuing the company's entire operation at less than what a legacy food brand routinely spends on a minor marketing campaign.
Right.
We're talking about the kind of capital a giant like Kraft Heinz or Unilever might burn through, just to test a new flavor of chips in a few regional markets and run a couple of Super Bowl ads.
The industry context is vital here. When a financial analyst looks at Beyond Meat, they see a distressed balance sheet, heavy debt, and significant cash burn.
So they value the company at zero.
Exactly. But when a strategic competitor looks at Beyond Meat, they are evaluating the brand equity and the intellectual property.
Right, because an acquirer isn't just buying a struggling balance sheet. The analysis report lists the hidden assets that these bankruptcy models are completely ignoring.
What kind of assets are we talking about?
A buyer gets one of the most universally recognized global brands in the entire alternative protein space. They acquire fully established global supply chains, highly specialized proprietary extrusion technology for creating plant-based textures.
An incredibly valuable, already secured premium grocery shelf space across the world.
Exactly.
For a conglomerate like Tyson Foods or Nestle, spending, let's say, $500 million to $800 million to acquire Beyond Meat would represent a massive premium to today's 79-cent share price.
Would send the stock soaring.
Oh, absolutely. But from the perspective of the acquirer, spending $800 million is a rounding error. It is a fraction of what it would cost them in capital, time, and failure rates to build a globally recognized plant-based brand entirely from scratch and fight for that international shelf space.
Okay, hold on. Let me play devil's advocate here.
Sure.
If I'm sitting in the boardroom at Tyson Foods and I can clearly see Beyond Meat bleeding out and heading toward bankruptcy, why on earth would I step in and pay a $500 million premium right now?
That's the million-dollar question.
Why not just grab some popcorn, wait for them to officially file for Chapter 11, and buy all those juicy assets out of liquidation for absolute pennies on the dollar?
It's a very fair point, and it's exactly what a lot of retail traders assume will happen, but corporate M&A operates on a different logic.
How so?
It's primarily driven by the need for certainty and speed. If you let Beyond Meat go into bankruptcy liquidation, you no longer have an exclusive avenue to those assets.
No.
You are suddenly bidding in open court against every other food giant, private equity firm, and venture capitalist who wants a piece of that IP.
Oh, so you risk losing the very technology you want because someone else outbids you in bankruptcy court.
Exactly. Furthermore, bankruptcy destroys brand momentum and severs contracts. If they go into Chapter 11, grocery chains will immediately pull Beyond Meat products and give that highly coveted shelf space to a competitor.
That makes a lot of sense.
Buying the company whole right now guarantees that the global shelf space, the supply chain contracts, and the proprietary technology remain completely intact and exclusive to the acquirer. Paying a premium now is an insurance policy against losing the asset entirely.
Wow. Buying them at these depressed levels is essentially a corporate cheat code to instantly dominate the plant-based sector overnight.
It really is.
But until a white knight acquirer swoops in, Beyond Meat's leadership still has to navigate this incredibly difficult period. And the analysis report brings up a fantastic corporate finance concept to describe what management is doing right now.
The kitchen sink quarter.
Yes, the kitchen sink quarter.
It's a classic survival strategy, particularly during periods of immense distress or when a turnaround management team takes the reins.
Explain how that works.
The report explains that the executives have actively been throwing everything bad, literally everything but the kitchen sink, into their recent earnings reports.
Just dumping it all out there.
They are voluntarily taking massive, painful asset write-downs. They are aggressively slashing their forward-looking financial guidance to the bone. They are airing all of their dirty laundry in one massive dump.
On the surface, if you are just reading the headlines, that sounds apocalyptic. It looks like the company is in a total freefall.
Right.
But the analysis report points out the contrarian genius behind this move.
Yeah.
This is highly intentional.
By resetting the market's expectations to absolute rock bottom, management is purposefully setting a very low bar for themselves to step over in the upcoming quarters.
They are essentially clearing the deck so that any future performance looks like an improvement.
Exactly. But we do need to look at the current reality of those numbers. The report details just how disastrous the financials are right now.
It specifically highlights a negative 160% operating margin.
Which is brutal.
Let's translate that into real-world survival terms for everyone listening. Because a negative 160% operating margin means that for every single dollar of plant-based burgers they sell, it's costing them roughly $2.60 just to keep the lights on.
Run the extrusion factories, pay the staff.
You don't need a finance degree to know you can't run a business like that for long.
You absolutely cannot. It means the core operations are actively hemorrhaging capital. However, the analysis report makes a crucial point about the path forward.
Right. Management is currently executing aggressive structural cuts to their operating expenses.
And if those cuts simply start to narrow that massive negative margin, the narrative shifts.
Because they don't need to suddenly show record profits to trigger the algorithms, right? They just need to show a trajectory towards survival.
Right.
If they can shrink that margin from negative 160% down to negative 80% and then to negative 40%, Wall Street will suddenly see a viable mathematical path to cash flow neutrality.
And the moment the institutional models see a mathematical path to survival, the overarching narrative entirely flips from bankruptcy imminent to turnaround in progress.
And that narrative shift is exactly what forces the algorithmic repricing, triggers the margin calls, and ignites the short squeeze we discussed earlier.
It is a rapid domino effect.
But as incredibly compelling as this contrarian bull case is, and it is compelling, we have to ensure this deep dive stays grounded.
Absolutely.
The analysis report provides a very stark reality check. If you are considering trading this setup, you need to understand the structural risks.
The research explicitly warns that buying Beyond Meat right now is a highly speculative, high-risk trade. It is emphatically not a traditional value investment.
That distinction is paramount. You are not buying a fundamentally sound, cash-flowing business at a temporary discount. You are betting on a highly distressed asset surviving against overwhelming odds.
Because the fundamental numbers highlighted in the report are terrifying. The company currently operates with negative equity to the tune of negative $601 million.
Meaning their liabilities far exceed their assets. And on top of that negative equity, they are actively burning through the little cash they have left.
The report notes they are burning roughly 30 cents on every single dollar of sales they make.
That cash burn brings up the biggest existential threat to anyone holding the stock at 79 cents.
Severe dilution risk.
Right. This is the catch-22 of a corporate turnaround. If Beyond Meat does not get bought out by a larger food giant, management still needs cold, hard cash to keep the lights on and fund these restructuring efforts.
And because their debt is already so high, traditional banks won't lend to them.
So what's their only mechanism to raise that survival cash?
To issue and sell millions of brand new shares onto the open market.
Think about your own portfolio if you hold those shares. When a company issues millions of new shares, it actively dilutes the ownership percentage of every existing share.
It's like having a pizza sliced into 8 pieces, and suddenly management slices it into 16 pieces to feed more people.
The overall pizza hasn't gotten any bigger, but the slice you hold is suddenly half the size and half the value.
Exactly. If management is forced into massive dilution just to survive another year, those 79-cent shares could lose significant value even if the company ultimately avoids bankruptcy.
The company might live to fight another day, but the current shareholders could still be severely diluted or effectively wiped out in the process.
This is exactly why the analysis report places such a heavy, non-negotiable emphasis on position sizing.
The report warns that a play like this, a highly speculative turnaround bet with astronomical short interest and terrible current fundamentals, should only occupy a high-risk, speculative sliver of your portfolio.
This isn't the basket where you put your retirement savings.
Definitely not. This is the portion of your capital where you are entirely willing to risk a total 100% loss in exchange for the mathematical potential of a massive multi-bagger return.
It requires extreme discipline.
Yeah.
You have to intellectually accept that the probability of the downside, total loss, or severe dilution is very real and historically common.
But the magnitude of the upside, driven by the unique mechanics of the short float and the algorithmic pricing, is what makes the setup so intriguing for a seasoned contrarian trader.
So true.
So we've covered a massive amount of ground today, analyzing both the explosive potential and the very grim realities presented in this research. Let's pull it all together for the final verdict.
The core thesis of the analysis report is not that Wall Street is wrong about the mistakes Beyond Meat has made over the last few years.
Right, the terrible operating margins, the alarming cash burn, the massive negative equity, those are very real, undeniable facts that management has to own.
But the report's defining argument is that Wall Street may have drastically miscalculated the forward-looking mechanics of the stock.
At a price of just 79 cents, accompanied by nearly 40% short interest, the broader market has left absolutely zero room for a positive surprise.
They have priced in a flawless, uninterrupted execution of the company's total demise.
And as anyone who has traded for a few years knows, financial markets rarely move flawlessly in one single direction without some violently disruptive surprises.
The analysis reiterates that if Beyond Meat manages to survive this gauntlet, this current price of 79 cents will be looked back on as a historic market anomaly.
Whether they survive through a brutal cost-cutting turnaround, or by being strategically acquired by a legacy food giant.
It will serve as a textbook case study of the pendulum of market sentiment swinging entirely too far into absolute irrational despair.
Right now, the report argues only the absolute worst outcomes are being priced in.
Only the worst.
Before we wrap up, I want to leave you with a final thought to mull over as you digest all of this. We spent a lot of time discussing the potential of an M&A buyout from a legacy food brand. Consider the broader implications of that scenario.
It's a really interesting angle.
If a disruptive company with proprietary technology and global distribution goes bankrupt, where does that intellectual property actually go? Does the plant-based revolution just die out, or does it simply get quietly absorbed, rebranded, and monetized by the very traditional meat conglomerates it originally set out to disrupt?
It's a fascinating paradox. The disruptors often end up becoming the highly profitable research and development arm for the legacy monopolies they tried to replace.
And it really makes you wonder if the financial markets can push a globally recognized brand to the absolute brink of zero purely based on momentum and consensus. How much of what we call investing is actually about fundamental business value, and how much is simply betting on the sheer psychology of the crowd?
It certainly changes how you look at the life cycle of innovation in the public markets.
It really does. Thank you so much for joining us on this deep dive into the contrarian bull case for Beyond Meat. We hope this look into the underlying mechanics of extreme market pessimism, short squeezes, and corporate valuation has given you some new tools for analyzing your own trades. Keep looking beneath the surface, keep challenging the prevailing headlines, and most importantly, keep questioning the consensus. We'll see you on the next deep dive.
Don't forget to like, share, and subscribe for more.